Hi everyone, welcome to the final video of chapter 3. We are going to end our cost volume profit analysis with a couple of easy formulas, margin of safety and operating leverage. Let's get started. So I love margin of safety because it's a super easy concept and it elevates your vocabulary just immediately. Basically, margin of safety is the cushion that your business has above break even. It's the difference between your current sales and your break even. It's how much you are above, if you are over, right? So what is that margin of safety? And you can always calculate if you're falling below it as well. But very easy. You take your total actual sales or your budget that you're shooting for minus your break even. So we would like to be $30,000, $50,000, whatever it is, above break even. It's just a fancy way of saying this is our cushion. Let's reinforce what we've learned from the previous two videos and add margin of safety with a quick example from Manteo Machine. They're a company that machines parts that are then sold and used in the manufacture of farm equipment. And here's their core product break-even analysis. We see their sales price, their variable cost, their contribution margin. By now, I hope if you've watched the two previous videos, you're super comfortable with this. They show us our fixed cost. We work through our formulas. We get their break even in units, the contribution margin per unit, the selling price per unit, again restated, contribution margin ratio, break even in dollars rounded. Pretty basic stuff, really easy. Please, quick practice before you go to the next slide. Make sure you can calculate both break even in units and break even in dollars just one more time. Now we can really easily calculate the margin of safety. We take Manteo's current sales, 2,500 units, times $90 selling price from the previous slide, gives us total revenues of $225,000. We take their break-even sales, which is actually 1,700 units from the previous slide, and that break even in dollars of 153,000. So we have a margin of safety above break even, 225 minus 153, $72,000. That's all margin of safety is. It's just a straight subtraction. How far are you above break even? We can then take that same information and use it to pre-plan. This is the best, most useful part of margin of safety, using it aligned with your target profiting to see how far above break even you can get at different margin of safeties, different contribution margins, playing out all our scenarios. So we can do that in units, sales at margin of safety. We can do it with a percentage using the formulas that you see here. So you'll notice sales at margin of safety. This is going to bundle margin of safety dollars and fixed costs just the way we did with target profit. We're just getting to a margin of safety above our fixed cost coverage. We can also calculate a percentage margin of safety. So I want a margin of safety of 30% above budgeted actual sales dollars. We can calculate those pieces using our margin of safety in dollars, shown here, divided by our total budget. So use what you know to apply and pre-plan how comfortable your cushion needs to be in order to survive whatever economic conditions your business is facing. Now let's shift gears and talk about operating leverage. Operating leverage really is about the percentage or the ratio of variable costs to fixed costs that a business is carrying and how they're managing that through the economic conditions that they're facing. In general, fixed costs are riskier. Think of owning big assets like a building. Remember, fixed costs you can't change or are harder to change when the economic conditions change, right? They're not tied to your product, so they're much more difficult to offload, and that's what makes them riskier. As sales volume goes up, though, right, your fixed costs stay the same. So when things are good, fixed cost is working in your favor because it's not going up with your sales. So you're more likely to make profit. But when things are bad, that fixed cost can hurt you. And we call that analysis the operating leverage. Now, again, economics and business overlap quite frequently, right? One is just the application of another. So for those folks who've been in macro or microeconomics, you might recognize operating leverage similar to the elasticity formulas that we calculated in those courses, giving us an idea of how sensitive a business might be to changes in their operating environment. Let's look at how the structure of variable costs to fixed costs can change the profit that a business is able to generate. We're going to use this starting information. We have sales of 10,000 units with a $10 selling price. Variable costs for those units are $4 per unit. So we have a $6 per unit contribution margin times 10,000 units, $60,000. Fixed costs of $25,000 and net income of $35,000. If we can shift some of our fixed costs to variable costs, this can change the equation. So now we're using that sensitivity comparison that we learned about in video number 2. Here in our first example, we shifted $10,000 of fixed costs up to variable cost. So we've made our variable cost higher per unit costs. This leaves us with less contribution margin, but we have less fixed cost to cover. And that leaves us with that $35,000 income. Similarly, if we lower the variable cost and we're able to shift some variable cost over to a more fixed cost situation, uncouple it from per unit, we end up with higher contribution margins, but we then have higher fixed costs to cover with those higher margins. It's always in a business's best interest to evaluate what kind of cost structure is going to work best for their industry and their performance levels. And this is why we do that. When our sales volumes change, your cost structure is going to determine where your costs are, what you're paying for, and ultimately how your net income will play out. So in this case, sales have increased 10%, but we've been carrying some higher variable cost because if your sales increase, your variable costs also increase. We have our contribution margin in this example still half. Covering that low fixed costs, though, means that when sales went up 10%, we generated an extra $5,000 worth of net income. In the fixed case scenario, again, sales went up, variable cost goes up, but our variable costs were lower in the high fixed cost example. So that gives us more contribution margin. So far we're okay. Those fixed costs stay the same. And again, as we mentioned a couple slides back, in a positive sales environment, a high fixed cost business is going to have the better payoff. Now let's consider where you might use this type of information in an analysis. The decision to shift away from employees and into automation is actually one of the biggest places where the variable cost, fixed cost trade-off can be used in an analysis. Here we have the question, should we introduce self-service checkout lanes? Right? Humans, especially frontline workers on assembly lines, checkout lines, those are often variable costs because you have to pay your workers per hour. If you need them more, they become more expensive. If you need them less, you send folks home early. But automation uses fewer people and equipment has greater fixed cost. So you can see here where a business has done that sensitivity analysis, just like we learned earlier, working through their sales variable cost contribution margin to be able to see how their income would change if they introduce automation. So this is just an example of the kind of application a business might have when they're thinking about decisions they need to make and the way they would use some of that information that we were just looking at in terms of the variable and fixed cost structure. Now we're ready to get to the operating leverage formula itself. We understand kind of what we're looking at. The operating leverage formula just is contribution margin divided by net operating income. So you get both of those things right off your contribution margin income statement. You're doing a little formula there. This is going to tell you your variability. The higher the degree of operating leverage, the more the good times are going to work in your favor, but the greater the possibility of risk later on. Lower operating leverage means that a little bit more stability, a little less variability. The highs aren't as high, but the lows aren't as low. Here we have an example. We've calculated the operating leverage of each company. For company A, that would be the 148,000 divided by 85,000. For company B, it is the 210,000 contribution margin divided by the 85,000. We see A has an operating leverage of 1.74. Company B has an operating leverage of 2.47, and 2 decimal places is fine for these. What this means is that B is going to have greater variability, greater sensitivity to the market environment. As the situation improves in the industry, if these guys are competitors, B is going to get higher highs, greater profits when the economy is going well and there's lots of sales. But if things go poorly and things start to lose money, the industry starts to fade a little bit, it's having a downturn, company B is going to be more sensitive to that downturn as well, and they'll see bigger losses. A will have much smaller bumps. The gains won't be as great in good times, and the losses won't be as severe in bad times. We can actually figure out how good or how bad using this formula. You take your degree of operating leverage number you've just calculated, multiply it by the percent change in your sales, and that will tell you how much your net operating income can change, either positive when it goes well or negative when things are going poorly. And we can see another example of that. Here is company A and company B after a 20% decrease in sales. So this is what we mean by high operating leverage creating problems for businesses. B is still sporting a higher operating leverage in this case. Same calculation, contribution margin divided by net income to get that operating leverage. Then we take that difference in net income from where they were on the previous slides to where they are. And we can see that for company A, they've now had a 34.8% decrease in their net income as a result of a 20% decrease in sales. So pretty elastic in terms of what they're able to generate as an income. But look at B. B has actually taken a much bigger hit. Their decrease, a 20% decrease in sales, meant a 49.4% decrease in their net income. This is the downside of having those higher fixed costs. It's fine when things are going well, but it really does create challenges when things start to turn and the economy is in a downturn. And that gets us to the end of chapter 3. Thank you for watching all 3 videos. Remember to reach out if you have any questions, and thank you so much for watching. Remember to practice and have a great day. I'll see you in the next video. Bye-bye.